to achieve today. So we hope you all find it really useful. Before we start, I think there's due to be a fire drill today, but I think it's at 11 o'clock, so we hope to be wrapped up by then. So, but if we're not, there's the emergency exit there. There's also one equivalent just outside the room on the right-hand side, and the assembly point is just over there. So hopefully that's self-explanatory. So my name's Gary Brown. I'm one of the audit directors at HWB. We've also got a number of other directors in the room, probably looking to do some CPD, I'd imagine. So if there's anything that you want to ask them, if you don't want to ask the room, then please feel free to do so. Joined by my colleague Alan Davies. I'll let him do his own introduction a bit later. What we want to cover today are those 5 key areas. So there's quite a lot of change coming in at Companies House. So we'll be talking about what those changes are and how they can impact you. Second point might be relevant for some of you, not all of you. You never know in the future though. Some changes to company size limits. It can change which one you fall into, so it can change certain disclosures that you may have to abide by. We've then got a couple of interesting areas. Revenue recognition. It's a bit of a bamboozle at the moment, so Alan's going to cover off that section, and leases as well. Again, it's something which is changing in quite a big way. So again, Alan's going to cover that, and then we're going to finish off the seminar by just going through some sort of high-level tax matters. If you please feel free to ask questions as you go along. There will be a time for questions at the end if you want to stick around, but don't worry about interrupting. We're all happy to field questions as we do go along. Okay, so start with Companies House changes. So ECCTA 2023. So that stands for Economic Crime and Corporate Transparency Act. So for some time, Companies House, and this is their own words, they've described themselves as sort of passive acceptors of documents. So what they mean by that is they're not really checking people, not checking who people say they are. And it's quite possible for any one of us to be formed as a director without us knowing on a company. And that picture there at the bottom right was taken from a news article where there was a chap in Cardiff who was getting about 200 letters a day demanding VAT unpaid. And what had happened was there was Chinese owners who'd set up companies with him as a director. So he was getting all of these chases for unpaid VAT from 11,000 companies. So it's still possible and it can happen today. So the Crime Act was there really to give Companies House more powers. So they sort of base it to 3 R's. So reject, remove, and rectify. It's quite difficult getting documents removed from Companies House at the moment. Often you'll just replace a document which might be inaccurate, but often that original document does still exist there. So the whole roadmap that they're looking at is to try and enforce these 3 R's. So there's a document on Companies House which is the Strategic Intelligence Assessment, so published 6 months ago, and it lists probably some sort of alarming areas really where they're seeing abuse, and I don't think they fully know how much abuse is going on at the moment. When we look at the second bullet point there, 750,000 companies were formed in 21-22. I checked yesterday and there was almost 900,000 in 2024, which is a staggering amount of companies. If you compare that to Germany, 140,000, and France, 80,000 I think. So that just shows how bad or how easy it is to form companies, I suppose. And this just means it's quite rife with potential things to go, fraud to go on, directors being named that shouldn't be named. So they're seeing a lot of massive corporations, so such as the poor chap who had 11,000 notices, but criminal gangs just trading online and just putting companies in the names of innocent people. VAT fraud, so setting companies up, again online, taking monies in for orders, and then disappearing, not paying over the output VAT onto HMRC. The fifth bullet point there, so company creation tourism. So a lot of criminal gangs are paying or offering holidays in the UK to people to use their details at company's house. So I could think of a better place to probably the holiday, but it does happen apparently. So just be aware of that one. And professional neighbours and formation agents. Now, hopefully we don't fall into this, but accountants will be professional neighbours, or some accountants. So particularly the ones who are not regulated by a supervisory body. So a supervisory body that looks at AML, so anti-money laundering type regulation. But also formation agents, because the formation agents it's low cost, so they would want the churn, they would want to be doing high volume type transactions. And we all know how inexpensive it is to actually form companies nowadays. So they're targeting those. So going forward, that's an area which they're going to be is on their roadmap to look at. Yeah, so I don't think scale abuse is fully known yet. So a couple of areas that they're looking at, probably most relevant today, and it's something which we are still exploring. It's still fairly early days, and that is verification of ID. It is coming in. So what they mean by that is any new director, any new PSC, so person of significant control, any member, any designated member, so will have to have their ID verified before they can become a director. Existing directors will also come into this as well. So it's currently voluntary. So from the 8th of April it's voluntary, but it will come in as being mandatory from autumn 2025. And then we think by autumn 2026, those existing directors will also have to have that ID checked. So you won't be able to file anything without having that ID checked. It will include anybody who's going to file documents for you as well. So it can include company secretaries, if they're the ones who are filing documents for directors. It will include us as well, if we're going to be the ones. And that's where ACSP comes in, so authorised corporate service providers. So directors can do it themselves. So it'll work very much similar if let's say you're applying for something online and you have to hold your passport up. You'll do a biometric scan. Alternatively, if you can't do that, you can either go to an ACSP, such as ourselves, we can do it for you, or post office is another way that you can do it, so somebody will be able to do it at the post office. If that person, whoever's doing that verification, if that's a manual process, so if it's not through a software scanning biometrics, that person is going to need to be skilled in spotting false ID. So we're going to need somebody at our organisation who's going to be able to spot false ID. So something we're looking at. Post office, obviously, they're going to need to train people to look at that as well. But probably the most majority of it's going to be mobile apps, software, those sorts of things. But it will become a point where you just cannot file anything without having your ID verified. Like I say, we're looking into becoming an ACSP, so it will be autumn this year when it really does kick in. The second part of the roadmap really, this is one which is happening, but we don't have a date for it yet, and that is that all companies are likely to have to file their profit and loss accounts. So currently at the moment, it's only medium-sized companies who have to file their profit and loss accounts at Companies House. So that's going to mean a lot more information out of the public domain, more information through employees, creditors, so we're not quite sure what impact that has. Their view is it just opens up the transparency and it just gives more power to creditors. There was a long consultation on it, but it's still gone through. What we don't know at the moment is what the format of the P&L will look like, how much information will be required to be disclosed. So this will apply to any size company, so it'll be micro entities, small, mediums do at the moment, and large do already. And then an audit eligibility statement as well. So it's official disclosure that directors will need to make on their accounts to say that they are eligible for audit exemption. So again, directors will need to understand what that means in practice. So one to ask your accountants if you're not sure. So those are the two main things at Companies House. Anybody got any questions on what's coming there? I mean, it's still early days. We're still trying to get to grips with ourselves. Where's Nick? I can't see Nick. Oh, you're there. Nick's leading internally for us, so we'll have more coming out at some point, won't we? So, yeah. So moving on to company size limits. So this will affect some of you in the room. I appreciate some of you aren't at the audit limits, but some of you may be in the micro and small company size. So I highlighted 6th of April because it's quite a strange start date. Normally associate companies maybe start their years 1st of April, but it's just one of the dates that legislation just comes in, as well as 1st of October. So any periods commencing after that date will need to look at the new thresholds. So if you look at the micro entity, it's pretty much jumped up by 50%, generally across the board, small size. So for a company to be small, it needs to be between 1 million and 15 million. Gross assets 500,000, 7.5 million. And then similar sort of thing for medium, needs to be below 54 million and 27 million gross assets. So that's your gross assets on your balance sheet. Interestingly, the number that's not changed, the average number of employees, so that hasn't changed since, I think these were last, 2016, I think it was last, these were last changed. So it just shows how long we've been operating under these numbers. Just to explain what average number of employees means, it doesn't mean if you've got someone working 2 days a week that you take 2 of the 5 and say, well, actually they're 2/5 of an employee. If they've got a contract, an employee contract, they are 1 for this purpose. So you can have, you can imagine some industries, hospitality, where they will have hundreds of employees, and that might push them over the thresholds, push them into the medium-sized thresholds.
Can I ask a question on that?
Of course.
Okay, so at the moment we kind of think of ourselves as an SME, small
Yes.
and medium. So here are they now going to say that there's a small and there's a medium and there's a micro. So the term SME will disappear.
No, it's always been the same. I think the SME is never really sort of associated with these company sizes. I still think they'll describe companies as SME.
So is this a Companies Act change?
Yeah. Yeah.
Because when you go through, and we've done this exercise recently for our business, for government tender, if you go through the Purchasing Act, the definitions are different from Companies House, and there are 3 or 4 different acts that define the difference. So when you get asked on a tender form, what are you, it doesn't refer to the act it wants you to comply with.
No.
So the definition when you're on the cusp of whether you fit into a small or a medium, or you define yourself as an SME, changes the way in which you get scored on a tender.
Yeah.
So it's very important to have the right definition. So this is a change in the Companies
Correct.
House,
Yes.
the Companies Act
Correct.
definition.
Yes, absolutely. Yeah, I appreciate that. You get all the different definitions, like for what's a small company or medium-sized company for transfer pricing, as an example. So, yeah, there's quite a lot of rules out there, but these are the ones which impact the Companies Act, and they impact the audit changes as well. Just at the top there, it does say company and net group size thresholds. On the next slide, we've got what they call gross group size thresholds. So, what that means is net is where you've got a group of companies, but it's got intercompany balances in it which have been consolidated out, so they've been removed. Gross is where you haven't removed those. And when you're trying to apply those thresholds, you can apply either. So you can find yourself actually that you could be small by virtue of the gross, but not small by virtue of the net. So if you're unsure, come and speak to us, and we can sort of guide you through it. But it's quite important because some people you can fall out of audit or fall into audit without really realising, because you might have breached some of those thresholds.
And you have to fail just one of them.
It's
to the
two.
next category.
It's 2 out of 3,
2 out of 3.
and it's for 2 consecutive years. So on the next slide, what I've done is I've put up an example. So let's say we've got a company of the year in 30 September 2024 normally. First period that's going to be fully after 6th of April is at the bottom on 30th of September 2026. So for 2 years, September 24 and the transitional year 25, it was above the medium size. It was above the small size threshold, so it was a medium sized company. So if those thresholds had stayed the same, it would have needed an audit because it breached 2 out of 3 of those thresholds for 2 years running. Under the new thresholds, 2026, it now qualifies as small. We're allowed for the transition rules to restate 25 and rejudge that under the new thresholds. So it can be small and therefore doesn't require an audit. So it takes a bit of getting around, but it seems to be in the favour, but it can move you from one band to the other quite easily. So it's something you're just going to need to keep a very close eye on. But the very top point really, kind of what I mentioned at the start, is that this is the first time since 2016 this has changed. So it's just this fiscal drag, it's not kept up with, like taxes, they don't keep up with, our personal allowances doesn't keep up with inflation. So you've got fiscal drag happening here. I would point out this is not for charities. So there's separate consultation going on at the moment for charities. They're looking at whether to raise the threshold to 1.5 million. So again, a 50% increase on charities. I think that consultation only started in May, Michaela, was it?
Yeah, ends the end of June.
Yeah. So if it follows suit, then there will be an increase there as well. I think the important thing here is, although it can move you from one side to the other and change disclosures, the audit exemptions are aligned to those thresholds. So if you're a medium-sized company, you will need an audit if you 2 years running. You need to be very careful of groups as well, because if you're a UK group who have got a foreign subsidiary in your group, and their rules are different to ours, you can't insist that they have an audit. Practically, it probably would still have an audit, but it can cause problems because it means that you still need, if you're a group, head of a group, you still need to audit those figures somehow when it comes into the group. So although the company itself might have an audit, let's say France, when it comes into the UK accounts, it will still need an audit. So something to watch out for there. On the flip side, let's say you've got a foreign parent company, and you're the UK subsidiary reporting to that foreign parent. If they turn around to you and say, well, we're medium, but we don't want you to have an audit, tough, you've got to have an audit, because you're medium-sized in the UK. So our rules say if you're medium-sized, you need to have an audit. So something to be wary of if your foreign parent says you don't need to have an audit. The final point on there is there's also the option of the parent company guarantee. So I don't know if anyone's familiar with this. So this is where, this can be for any size subsidiary. So this is where the parent company guarantees the liabilities of the subsidiary. That subsidiary in its own right can then be exempt from having an audit done. However, you need to watch out for, it still needs to be audited when it comes into the parent company accounts. And also, do the members of that parent company know what they are guaranteeing as well? Because you're guaranteeing the liabilities at balance sheet date of that subsidiary. So you're stepping out of that ring-fenced limited company structure. You're kind of just knocking down the walls there, really. So be careful if that's something you do choose to go down. Make sure you're fully aware of what you're going to do. Any questions on that? I know it doesn't apply to everyone in the room. Something to watch out for. Okay, on to the exciting bits. The first one is in.
Thanks very much, Gary. Okay, thank you. Yeah, thank you. Good morning, everyone. My name's Alan Davies. I'm an audit manager at HWB. I specialise in quite a wide variety of different businesses, a lot of corporate clients, and also have a specialism in not-for-profit and academy schools. And in this part of our presentation, we're going to bring you up to date with some amendments to FRS 102, which is the accounting standard which is used by most private companies. It's issued by the Financial Reporting Council, FRC. We've had it in place for around 10 years now. The FRC's aim is to keep FRS 102 in line with global accounting standards. Their aim is that it's up to date, reflects latest developments, and provides high quality reporting. So after we've talked about these far-reaching amendments, we'll let you be the judge of whether it's high quality reporting. But we'll run through it and explain what the changes are. So they have a 5-year cycle for making amendments to this standard. The first set was actually back in 2017. It was fairly minor and actually quite helpful in a lot of respects. Had some simplifications, for example, accounting for directors' loans to companies which were interest-free. This second review is a lot more extensive, and we're going to see some significant changes coming in. So our recommendation is to look at the potential impact as early as possible, really. So the changes could have some effect on quite a few key performance indicators. It could affect operating profit, potentially if you have any kind of remuneration targets in place, they could be affected. It might affect the decision as to whether to lease assets or buy them. It could impact compliance with bank covenants or relationships with lenders or other investors. Not going to be significant for everybody, but in some cases it could be. We're looking at an effective date for, in most cases, periods commencing 1st of January 26. So for most people that's going to be 31st of December 26 year ends and onwards. We do have one thing that's coming in earlier, 1 year earlier. It's called supplier finance arrangements. Not really very common, but this is situations where a third-party finance provider pays a company's supplier directly, and then the company repays the finance provider instead of settling with the supplier as they would do normally. So it's this sort of triangular financing arrangement. The change there is only disclosure. Like I say, it's coming in 1 year early, so if it does apply to you, that's just something to have a look at. There are some transitional arrangements, and we'll summarise those as we go through. As Gary said, the main changes we're looking at are going to affect revenue and they're going to affect leases. That's the two big changes coming in. There's a few other minor things. We've also got some changes to small company disclosures going through. And towards the end, I'll also touch on going concern. Starting with revenue, at the moment we've got one section of FRS 102 dedicated to revenue, which is very much scenario-based. It's got around 27 different examples of different types of structures, giving advice on how that revenue should be accounted for. Now we're moving to more of a conceptual basis. We have this 5-step model which should in theory apply to everybody. Sounds a lot more simple on the surface. As always with these things, the devil's in the detail a little bit. So we'll look at those 5 steps now and just go through and explain some of the nuances in each one. So step 1, probably the easiest step for most. Contracts are usually written, could be oral or implied, but in most cases it's going to be generally straightforward in terms of identifying that contract between the customer and the supplier. As you can see there on the bullets, there's some hallmarks, if you like, in FRS 102, which identify where we've got a contractual arrangement in place. I think one to look at is just the contract's got to have commercial substance. So what we're getting at here is genuine arrangements between customers and suppliers, and it's not anything that's a sort of contrived type arrangement. So step 1 is generally going to be fairly straightforward. Step 2 is where it gets a little bit more complicated, and in this case we have to identify within the contract each of the different performance obligations. Now that's really where we're, as the standard calls it, promising to transfer a good or a service onto the customer. And in terms of looking at those contracts, we could have a single contract that's got more than one promise or performance obligation in it. And that's where we have to be a bit careful, because the standard requires us to look at where these different obligations have to be considered separately, i.e. distinct, or where we can combine them into one thing and just account for them as a single item. So distinct or combined, really, a good or service is going to be distinct if the customer can benefit from that particular aspect of the contract on its own, or in conjunction with other readily available things. And it's separate from other promises in the contract. Where it could be combined is where we can't separate those two things out into different aspects. It could be, for example, if we're supplying and installing a machine can't be used unless it's properly installed and commissioned. So we have to treat that as one thing. Similarly, if we're supplying a standard product and then modifying it for a customer, we can't separate out the standard product and the modification.
Just to clarify on that point, if you are supplying somebody with an instrument and they would need, it would need like an installation come training session for them to be able to be using it, you would invoice the whole at the end of the training session, not the shipment of the instrument as one invoice and the training session as another.
I think probably you have to look at whether or not those different aspects can be separated out. So, for example, would you supply the training on its own to other customers, for example, or is it something that you always supply as one thing and never normally separate out?
We would do it both ways.
So I think you'd have
in
to...
an instance where it was one customer, one instrument plus the training, would that be invoiced at the time you complete the training, or would it be able to be split so you can take the revenue for the instrument before you take the revenue for the training?
Potentially you might have to separate it out into different aspects, because you could potentially supply that training separately from the actual instrument itself. So this is an aspect of this standard where we might see some changes, because
I was just going to say, because in that particular instance we do always bill the instrument because it's left our building and the liability changes. But then later when we've done the training, we'll bill the training. So we do bill it separately now. So are you saying there will be a change from that process or not?
When something is billed or invoiced, if it's billed or invoiced separately, that doesn't necessarily matter. It's more how the revenue is recognised in the accounts. In this case, we're just looking at if we need to separate these two aspects out and potentially apply a different accounting treatment as to when we recognise the revenue. If it's supplied in some cases separately, then that would be an argument that says you may have to break those two things into two different performance obligations, and then when you're applying this 5-step model. But it's going to vary case to case. It might be one where we need to have a more of a detailed look into the specifics and see whether or not that constitutes two different obligations. Like I say, where things can be distinct is where you do have the option to buy it separately. So potentially we're looking at things like installation, servicing, perhaps warranties, that sort of thing. So before, whereas we might have rolled that into one thing, now we might have to separate that out. So there's going to be quite a bit of judgment involved moving forward. So we've got our different obligations in the contract. Now we have to determine the transaction price. So this is step 3. In a lot of cases, again, it's going to be very straightforward. If we go into the shop and buy something, we know exactly what the price is going to be. But in some cases, it can be complicated. So, for example, we might have prompt payment discounts. There might be things like contract penalties, where if we deliver a project late, we're going to have a penalty of 2.5% or 5%, whatever it might be. Or we might be selling things where the customer has a right of return, and in retail you'd typically expect that you might sell a number of products, but you know that a few days later there'll be refunds where the customer wants to bring it back, get a refund or swap it for something else. So in some cases it's not always straightforward. If it's a long-term arrangement, we might have to look at the time value of money as well, if it's over 12 months. So with this variable consideration, the aim is to only really recognise the revenue that we're expecting to receive at the end of the contract. And the standard requires us to only recognise that revenue if it's highly probable that we're going to receive it. So highly probable, again, very judgmental, but it's quite a high bar in terms of actually recognising that revenue. The standard allows us a couple of options as to how we make that determination. So we can have either the expected value or the most likely amount. So the expected value would be where we have a range of different outcomes. So it could be, for example, that contract where we have penalties for delivering it late. We know if we deliver it on time, we're going to get so much, and it could go down again, perhaps. In that case, we might want to use the expected value method, where it's basically a weighted average of the probability of receiving certain amounts of different prices. Or the other option is the single most likely amount. So again, there's judgment involved here, as we have to choose the method of how we're determining the transaction price. We could also see different liabilities and assets on the balance sheet in respect of the right of return. So that scenario where we're in retail and the customer we're expecting to receive so many returns back into our shop. We might have to make a provision in our accounts, reduce our revenue, and put a provision on the balance sheet for the returns that we're expecting to come in. And the flip side of that is that we'd also have stock that's going to be returned to us, it's going to come back into stock, and that's going to be an expected asset. So there might be these other assets and liabilities on the balance sheet. So we've identified our contract, we know the different obligations in there, we've worked out the price. The next step is to allocate that price across the different obligations that are within that contract. So the standard requires us to look at the standalone selling prices of each of those different obligations. So for example, your example, the instrument would have, say, a standalone selling price. The training might have a separate standalone price. But at combined cost, we might offer a lower price because the customer is buying it all in one item. So for example, here we have a machine which is supplied with installation and a 1-year servicing. And although each of those different components, the machine 40,000, the installation 10,000 and the servicing 5, adds up to 55,000. In this case, because the customer is buying it in one go, we're selling it to them for 48,000. Now, because we might have to recognise these different obligations separately, the standard requires us to split out the total price between each of the different obligations in the contract. And the method of doing so is just pro rata based on those separate standalone prices. So you can see there the percentages for each element of that contract are applied to the total price, and we allocate that price on that method across the 3 different obligations in the contract. Now, we're not always going to know the standalone selling prices, and in those cases, the standard requires us to make an estimate, basically. So it could be an estimate based on similar products in the market, or it could be an estimate based on our costs, for example, like a cost plus method, something like that. But again, judgment involved because we have to make this estimate as we go through. Then we come to the last step, which is to actually recognise the revenue. And that revenue is recognised as each of those different performance obligations are fulfilled. And again, judgment is required here because the standard gives us two different methods of doing it, and we have to choose which one is most appropriate. So the revenue is either recognised at a single point in time, or it's recognised over time. And again, it's down to us to assess which one is most appropriate. And a single point in time recognition will be most appropriate when it's a customer that's just taken away, gained control of an asset, they've got title to that asset, they've accepted it, they have physical possession, and we have the right to receive payment from them. So again, typically we're looking at something like retail, where we're selling something or supplying an item to a customer. Over time would be where the customer is receiving, consuming the benefits of that service over a period of time. So we could be looking at something like servicing, a warranty, or a service like cleaning or something like that, where we're supplying it over a fixed period of time. We recognise it as we go. It could also be appropriate where the asset is created or added to over a period of time. So for that we could be looking at something like a construction contract, where we're building something, it's going to take maybe a couple of years, and in that case it's appropriate for us to recognise the revenue as we go. And finally, the overtime method would be where there's no alternative use for what is being delivered to the customer. And here we're looking more like things like professional services, where it could be, say, a firm of solicitors working on a case for a client. It's going to take a number of months. That time's gradually being incurred. There's going to be no alternative use for that. They can't, if the customer says to stop work, they can't then use that same work on another client. It's gone. So that is something, again, that's measured over time. And in terms of measuring the progress of those over time products and services, again, we have a choice. We're required to use either an output or an input method to assess the progress. So an output method could be, for example, something like a survey or evaluation. It's a building project. Someone is coming in and they're assessing it, telling us how far through we are. If we're 25% of the way through at the year end, we recognise 25% of the revenue. Alternatively, we could have an input method. That's more of an internal measure, like the time that we spent so far, the costs that have been incurred so far, or labour hours to date, something like that to measure the progress. So again, it's not straightforward. We have to choose the method. As you'd expect, we also have quite a few different disclosures for this, so that's an area where we're going to see some change as well. So there's a lot to think about here. As we see, there's going to be an effect on either the amount of revenue we're recognising or the timing of when we're recognising it. It could impact the performance-related bonuses, other KPIs. We might have to be aware of this when we're budgeting sales, preparing forecasts. It could affect our corporation tax, because we might be recognising revenue earlier or later. The tax liability will be affected accordingly. It's something we might have to make legal or marketing departments aware of. If a contract's being drafted, is it being drafted the way we want it to, such that the accounting will be how we want it to be? If our marketing departments are offering things like discounts or warranties, we might have to look carefully at the wording that they're using. Is that going to end up being a separate performance obligation that's going to have a knock-on effect on our accounts? So it's quite quite wide-ranging. As we've seen as we've gone through, there's a lot of judgments along the way. There's 2 or 3 key areas where we could be required to make judgments as to which method we use, for example. And we've got different disclosures. The first-time adoption is slightly unusual in these FRS 102 changes. Normally, when we have changes in accounting standards, the method is that we have to effectively pretend that they've always been in place, go back, restate the comparative figures. For these changes to FRS 102, there's no restatement of comparatives. So we just have to apply this. Again, a choice. We can either apply it retrospectively, but like I say, there's no adjustment of comparatives. We look at contracts that are in place with the date of transition, and any effect of that change is just going to be shown in the accounts of that first year as an adjustment to the opening reserves. So we're not going to restate the comparatives, we're just going to have a one-liner in there which shows what our reserves were last year and then the effect of this change. So it's going to make that first year accounts look quite strange, because in some cases it's not going to be very comparable. So a lot to think about there. Take a deep breath, count to 10, and then we'll move on to leases. This is the other area where we're seeing a lot of change. So we've historically had 2 different accounting methods for leases, finance and operating. So finance, we'll explain those with current accounting treatment and the new accounting treatment, but finance leases are generally those type of longer term leases where we're having more of the risks and rewards of ownership. So it could be, for example, where we're leasing an asset not for a short period of time, but for most of its useful life. By the end of our lease period, that asset's not really going to be in a great condition to go on to someone else. It might have to be scrapped or decommissioned. It could be that type of thing. Operating leases is everything else. So it's more of the short-term leases where we're just leasing something for a shorter period of time. Once we've finished, it's going to go back to the leasing company and go on to someone else. So we'll go through the different accounting treatments, but the upshot is that more leases are going to end up being treated as finance leases rather than operating. And where we're going to see a big effect is on property leases, not so much with plant and machinery, but where businesses or entities are leasing their office space, for example. That's where we're going to see a big change. So have a look at the current accounting treatment. Operating leases is really simple. The rentals that we pay just go through the profit and loss account as an expense. Very straightforward. Finance leases, like I say, these are cases where it's more akin to owning the asset, even though we're only leasing it. Like I say, we're having it for most of its useful life. Perhaps the rentals that we pay actually add up over time to almost what it would cost to buy the asset. It's these type of things. In these cases, because it's akin to ownership, we show that asset on our balance sheet within fixed assets. We depreciate it. We show a matching liability on our balance sheet for the lease rentals that we have to pay in the future. As we depreciate the asset, it comes down. As we make the lease rentals, that liability comes down. At the end, they come down to 0. We have a depreciation charge on the asset as we depreciate it, and there's an interest expense on the liability, and those things go through the profit and loss account. So the differences are operating lease, nothing on the balance sheet, and all of the rentals go through the P&L. Finance lease, you have the asset on the balance sheet, you have a matching liability, and within your P&L, instead of that lease rental expense, you have a depreciation charge and an interest charge. Going to work out fairly similar over time, but there's going to be some tiny differences. So that's where we are at the moment. So where we're moving to, unfortunately, is away from the simple and more towards the complicated, because more leases are going to be shown as finance rather than operating. We've got a couple of exceptions, thankfully. Anything short term, and that's 12 months or less, we can just treat that as an operating lease and just put the rentals straight to the P&L. So anything that's just a short-term lease is going to be quite simple in that respect. The other exemption to this more complicated accounting is leases of what's defined as what's called low-value assets. Obviously that begs the question, what is a low-value asset? And there's not really a clear definition in the accounting standard as to what constitutes a low-value asset. I mean, all the definition says is something that can be used on its own and is not interdependent with other assets. Very accounting speak, quite judgmental, not really easy to put your finger on. More helpfully, the standard clarifies a few things which definitely aren't low-value assets. It definitely excludes any vehicles, and that could be motor vehicles, also construction-type vehicles. It excludes any land and building leases, so anything to do with leasing shop or office space. And it excludes any big items of machinery like production lines, that kind of thing. So we know these things are definitely not low value. What could be low value? We're looking at things like computers, laptops, desktops, tablets, for example. We're looking at office furniture and things like mobile telephones, photocopiers, that type of thing. So a lot of companies are going to find that all of the sort of equipment they might lease, IT or office equipment, they can treat that as low value, go for the simple accounting treatment, but they might find that they're stuck with their office lease, their shop lease, that's going to require a bit of thought. So let's just have a look at an example of how this is treated. So if we just take a very simple 3-year lease, we're leasing something, we're paying £10,000 a year. Under the operating lease treatment, like I say, very simple, the rentals just go through the P&L as an expense. And I should say, we will distribute these slides after the webinar, so just in case it's helpful to have this as reference. Very simple with the operating lease. Finance lease is where it gets more complicated. So in this case, we've got to make an assessment of what is the present value of our asset and lease liability at the start of our lease. And the way that's done is by looking at rentals that we pay, applying an interest rate to those, and then discounting those back to get a present value of the rentals at the beginning of the lease. So again, it's taking account of the time value of money, discounting those rentals back. It's something that you can work out using a spreadsheet. The Excel formula, if you need it at the bottom, is there. It's the PV formula. So in this case, PV, present value. In this case, we're assuming an interest rate of 5%. We'll come on to interest rate shortly. The free refers to the free instalments of the repayments, and the negative 10,000 refers to the 10,000 payments that we're having to make. And that produces a present value of just over 27,000 in that case. And you can see in the second table on the right there, that 27,000 is what we're recognising at the start as our asset and liability. So the accounting entry, quite straightforward. We're debiting the asset. It's a separate class of assets called right-of-use assets. We don't own them, we just have the right of use. And the credit goes to lease liabilities on the balance sheet. Fairly straightforward. As we go through, we have to apply that 5% interest to our lease liability, and that goes to the P&L. And then we make our £10,000 repayments. So two things to note there. Firstly, as you'd expect, by the end of those 3 years, the lease liability comes down to zero, it's finished. But secondly, the interest is front-loaded because it's applied as a constant percentage rate to the outstanding balance. So it's not a straight line expense, we're recognising more lease interest up front. So that's the liability bit. If you then look at the asset bit, I've added 3 columns on the end. We have our £27,000 asset. We're required to depreciate that over either the shorter of the lease term or the useful life. In most cases, that's likely to be the lease term. So in this case, we're depreciating that evenly over 3 years. At the end of that, the asset goes down to 0 on our balance sheet net book value. So instead of that £10,000 a year lease rental, in our P&L, we have an interest charge and we have a depreciation charge. So the end column there is the total P&L effect, and you can see that due to that front loading, we're going to be recognising more up front. Not a great deal, but a little bit. The big impact really is going to be on our balance sheet, because before we had nothing, and now we've got, in some cases, what could be a large asset and a matching liability. That's where we're going to see big changes. So we've got all sorts of practical issues with this. While the accounting might be relatively straightforward in theory, there's things that in the real world are going to make a difference here. So the lease term is not always obvious. It might be if we're leasing, say for example, an item of machinery, but if we're leasing our office, we could have, for example, a break clause or an exemption, something like that. We don't know exactly what it's going to be, so I'll come on to that. Variable lease payments, again, it might not be £10,000 a year, it might go up with inflation, that kind of thing. There's that discount rate issue. What rate do we use? Again, the transition is potentially complicated, and this is going to have a knock-on effect to our corporation tax. So let's just have a look at those. The lease term. So like I say, it might not be as simple as 3 years or something like that. We have to make an estimate, and in doing so, we have to make that estimate with what's in the standard is required to be reasonable certainty. So we're looking at, is it likely that we might end up extending that lease or exercising a break clause to terminate it early? And in doing so, we have to look at past practice, for example. What do we normally do? Do we always normally take these sort of options? It might be relevant, because it might only come along once in a blue moon. There's other things that we have to look at. What's the cost effectiveness of exercising, say, a break clause? Is there going to be a penalty that we'd have to pay that you could say, actually, that means we're less likely to exercise this clause? We have to look at the investment that we might have already made. So, for example, if we're leasing an office or a shop, have we spent a lot of money on improvements, for example, that will mean that we're less likely to want to move out? We're required to look at, does that lease satisfy everything we want from an operational point of view? You know, if we're happy with it, if it's doing everything we want to, we're probably not going to want to change it. So it's these kind of practical things we have to look at to make a judgment in determining that lease term. As we go through, we have to make an assessment to reassess that for anything that's changed. The variable lease payments, like I say, it might not be fixed. We might have something that increases by inflation or an index. We might have something that we have to pay an extra amount based on, say, in this example, a retail unit with a fixed amount plus a variable amount based on what we sell. The standard requires us only to build in variable amounts if they relate to an index or a rate. So in that example at the bottom, the variable amount is based on sales. It's not based on an index or a rate. That bit, we just take it straight to the P&L. We don't build it into our calculation over 3 years or however many years it is. I won't dwell on these other bits so much, but in some cases we might have different elements that are within that lease contract. We might be leasing, say, office, but we might have other things in there. We might have, for example, cleaning, a shared reception desk, something like that, servicing, security. We might have other things that we have to separate out from our lease. That's what the standard requires us to do. And again, like the revenue, it requires us to look at what's the standalone price for these things, making an estimate. Thankfully, in this case, we do have a practical measure. We can elect to account for all of those different things as part of one lease by class of asset if we want to. So it does make it easier. Difficult one is the discount rate. What percentage do you apply in working out that net present value at the start of your lease? The standard requires us to look at the interest rate that's implicit in that lease. Well, we're not really going to know that. That's something that really only the lessor is going to know. So when we take out that lease, we know what the payments we're going to make are. We know what asset we're going to be using. We don't really know what the interest rate in that is. It's dependent on a lot of other things. What will that asset be worth at the end of the lease, for example? So it's not really very helpful. It gives us another couple of options. We can make an estimate of the rate by looking at what our typical borrowing rate might be. And again, it's complicated. There's two options, incremental or obtainable. Again, it's looking at what loan you would have to take out in order to finance those lease payments if you were buying that asset. The incremental one is more complicated because it looks at what that asset is worth and what security you'd have to provide. The obtainable is a lot easier, and in practice this is what we're going to see, because it's going to be companies looking at what would we have to borrow, say from the bank, to finance that, for example, £30,000 worth of lease payments, say for 3 years. What loan would we have to take out? What interest rate would be on that loan? We're going to have to make an estimate. There's a lot of judgment involved, and it's just going to have to be a reasonable estimate based on what evidence is available. But again, more complicated. Again, transition, no restatement of comparatives, and again we have that adjustment to the opening reserves. Luckily there are some practical measures. We don't have to look at, if we've got lots of leases in place, we don't have to look at the interest rate on each one. We can estimate a single rate for similar leases. We can ignore short-term ones, and we can use hindsight in looking at things like break clauses, extensions. So a few amount of practical measures. So again, there's a lot to think about here. Corporation tax I haven't mentioned much, but effectively we can see some big changes here because with the operating lease arrangement, it's quite straightforward. We have our operating leases going through, our rentals going through as a deduction in each year. We claim a corporation tax deduction on the leases. With the more complicated treatment, we don't have that rental going through. Instead, we've got an interest charge and depreciation. While the interest charge, we can claim a deduction on that. Depreciation is something that you can't normally claim corporation tax on. It's added back, and instead companies get capital allowances, for example. In this case, the depreciation is going to be an allowable expense in the corporation tax computation. As with revenue, there's going to be some knock-on effects here. We could say changes to operating profit because we've had operating lease rentals which are above the line and now going to be replaced with depreciation and interest which is below the line. Liquidity ratios. Our balance sheets are going to look potentially quite different because we've got an asset on there we didn't have before and a liability that's new. It might affect bank covenants, for example. So something that's really important to have a look at early on, is it going to affect you? Potentially look at your property leases in particular. As Gary was mentioning earlier, the audit exemption is based on the company size criteria. Part of that is gross assets. We're adding an asset onto our balance sheet, so it's going to push up gross assets and bring us nearer to potentially medium or large company status. It might affect our audit exemption. So like I said at the start, lots to think about, and if in doubt, please do grab us and have a chat and see how it might affect you. I'll briefly talk about small company disclosures. That's the other item that's changing in the revised FRS 102.
Before we move on from the leases,
If you have a property lease where you know what the increments in the payments are going to be in a period, do you use the total cost of the lease period to calculate those figures, or would you use it in incremental brackets for when the increases happen?
If you know exactly what they're going to be, then use those payments. If they're fixed at a index or a rate, you have to estimate what you think that might be. But anything else, you just ignore it. So it's if they're defined in the lease, you use those payments.
So you use the total amount of payments throughout the...
Yeah, exactly right. Yeah, that's
And
it.
would that calculation state, so it's say a 10-year lease, year one you work that out, you wouldn't have to review it so the interest rate went all the time or anything like that, and stick with the same calculation, or would you have to review it each year?
I think if it's changed significantly, you'd have to take another look at it. But again, you could probably apply materiality in saying, if it's not a material change, just leave it as it is. So let's hope we don't have any big swings that are going to make that big a difference on it. But in theory, you might have to, but hopefully not. So the small company disclosures, FRS 102 applies to everyone really. Small, medium or large. Micros have their own accounting standard, FRS 105. Might be more attractive now because the leasing and revenue is more straightforward in that world. In FRS 102, Section 1A deals with the disclosure for small companies. Previously, when we were part of the EU, the UK accounting standard was restricted to how many disclosures it could require small companies to make. And that led to the old FRS 102 having things that were encouraged but not mandatory. Things to do with disclosing material uncertainties to do with going concern, or dividends, for example. They were encouraged, but you didn't have to put them in there because the FRC couldn't ask us to because it was against EU regulation. Now, unfortunately, post-Brexit, they've taken the chance to add more in because we don't have that restriction anymore. Those disclosures that were encouraged are now required for everybody. So any material uncertainties or dividends are in. Small companies, as you might expect, we've seen changes to leasing and revenue. We've got more disclosure in those areas. Also, there's new requirements there for provisions, the detail behind provisions. If we have share-based payments, things like share options, EMI, that kind of thing. Previously, we had this strange scenario where the accounting was quite complicated. There was no disclosure whatsoever. Now we've got the disclosure. We also have more disclosure to do with the tax charge. Why is the tax charge different to what you might expect given the prevailing tax rate? We have to put a reconciliation in. There's more there, but it's worth noting that the disclosure is only for material items. So it's not that we might have to put everything in, provisions for example. If it's not material, there's no requirement to include it. So those are the main FRS 102 changes that we have. We also have some changes in, that will affect going concern with FRS 102. Previously, we had to just disclose any material uncertainties. So if there was a material uncertainty to do with the company continuing, a problem to do with profitability or liquidity, we might have to make a disclosure in there. Now we've got more disclosure. There is a positive confirmation required that the financial statements are definitely prepared on a going concern basis. And again, a positive confirmation that the company management has considered all of the available facts and information when making their assessment. And they've got to disclose any significant judgments that they make in doing so. And that means that we could have more disclosure if there are, for example, close calls, things where we might conclude at the end of the day that there's no material uncertainty, but we have to think very carefully about doing it. We could have more requirement in there, more requirement for disclosure in there. And that's in small company accounts as well as medium and large, so potentially a bit more disclosure in there. The other thing we just wanted to flag to you at this point is that the FRC have released guidance to companies to do with making their assessment of going concern. This guidance was issued back in 2016, but they've recently updated it. There's not a huge amount of change in there. There's a new version that was issued recently, not just for accountants, it's also for company directors in making their assessment of whether their company is a going concern or not. So there's no huge changes in there, but we just wanted to make you aware of it and what it is. It's really intended for medium or large UK companies, not so much for small companies, and it's intended to be fairly easy to use. The requirements, examples and terminology that are used in that guidance are colour-coded to make it easy to follow. There's a link on the screen to where you can find it. It's a document that looks like that. And the contents really are some guidance to company directors in making their assessment of going concern, what they're required to assess and how to do it. So for example, what assessment period do they look at? How far into the future are we required to look at in assessing that our company is a going concern? It gives guidance on things like solvency risk versus liquidity risk. Our company might be profitable, but do we have the cash to continue trading successfully during that assessment period? So there's guidance in there. It clarifies the reporting requirements. What are we required to put in, for example, our strategic report in the accounts? What are we required to disclose in the notes, particularly post these changes to IFRS 102? Like I say, it gives guidance on how to assess going concern, particularly in preparing forecasts and cash flows. As well as giving that guidance, it also gives guidance on how to consider materiality and proportionality in there in making your assessment. So really we just wanted to flag post that to you just as something to be aware of and look at if it's relevant for you. So I hope that's useful on IFRS 102. Did anyone have any other queries? If not, I'm going to hand back to Gary.
Thank you, Alan. Right, just conscious of the time, I think we are gone over, so thank you. This is sort of fairly high level on the tax side. Didn't want to cover things like HT, pensions, not my bag really. But so if you do have any questions on that, then we can refer those to our tax team back in the office. So corporation tax. So first point on there, we see a lot of companies struggling with this one, falling foul of this one. So companies that are deemed large, these aren't the same threshold as we saw before for audit thresholds. Companies that are deemed large are where you've got profits over 1.5 million. And companies that are deemed very large for corporation tax purposes are companies where you've got profits over 20 million. So some quite sizable companies. So that's fine, that's quite straightforward. But with quarterly instalments, it is what it sounds like. You have to, if you're a large company, you have to pay your corporation tax bill 2 months, 2 quarters in advance of your year end, and then 2 after year end. So it accelerates the tax payments. If you're very large, they all have to be made before your year end, all 4 of them. So it accelerates it by another 4 months, 4 months earlier. So that's fine. So a lot of companies don't fall into those 1.5 million or 20 million brackets. But what we saw in April 2023 was a change to what they call the associated company rules. And associated company rules pretty much mean that, well, where you've got perhaps a group company, or you've got 2 companies under common control, perhaps they're financially, operationally interdependent, perhaps they're family-orientated owned companies, you have to look at them and think, are they associated with corporation tax purposes? If they are, then those limits, those 1.5 million and that 20 million, basically get reduced. and they get reduced by the number of associated companies. So if I've company A and I've got 2 companies that are associated with my company, then that 1.5 million gets divided by 3. So myself and the other 2 associated companies. So all of a sudden, my company falls into that quarterly instalments regime. So it's something to be wary of if you've got groups or you've got other companies that are under common control. It can also impact the tax bandings as well. So we've got tax bandings at the moment which under 50,000 you're paying low corporation tax rates, between 50 and 250 you're paying marginal tax rates, and above 250 at 25%. So it can pull you into, change you into a different rate or push you up into a different rate. So it's something to be mindful of. So if you've got groups, just have some thinking about that. We know the AIAs, so these are the capital allowances. So when you buy plant and machinery, you get 100% first year deduction on computers, anything you buy for the business which is of capital nature. So that 1 million is here to stay. Very few businesses actually use that, but it's a good tax relief, so that's here. But there's also something called full expensing as well. So if you do find that those AIAs that you're going over that 1 million, we've got something called full expensing. So full expensing is effectively 100% first year allowances for normal plant machinery, but also then 50% on anything which is deemed to be integral features. So cold water systems, heating systems, like those sorts of things. But what we would encourage though is for, if you've got the AIAs, is to use them first rather than use the full expensing. The reason being is that with AIAs you get 100% on the integral features, with full expensing you're going to get 50% on the integral features. So if you put a new heating system into your building, then we want to try and claim AIAs rather than integral features. The second point as well is we have to, under full expensing, we have to itemise those assets, and when they get disposed of, you then basically get balance and charge on capital allowances, which brings it into a taxable receipt when you dispose of it. Whereas if you dispose of it out of AIAs, it just comes off of the writing down allowance carried forward. We need to be careful of when capital expenditure is actually incurred as well. So we need to watch a few traps. So the first one, the point here is that it's deemed to be incurred when the obligation becomes unconditional. So that normally means when it's been delivered, the asset's been delivered to your business. But you need to watch a couple of traps, one being where actually it's unconditional, but there's a payment, the terms of payment are delayed by 4 months. Or perhaps where you pay for something up front, you expect to get the capital expenditure up front, but actually you don't get it delivered until perhaps 4 months down the line. So that can actually defer when that capital expenditure is available for capital allowances. HP is different. They allow HP to go through right at the very outset. So even though you're paying for it in increments as you go along, the HP is allowed for capital allowances when you first take out that agreement. Directors, employees, benefits and taxation. So quite recently, they're mandating PWD payrolling. So we thought it was going to be 6th of April 2026. So basically any benefits such as private medical, cars, would need to go through your payroll. After a lot of pushback, because HMRC weren't ready, businesses weren't really ready for this as well, they've now deferred that to 6th of April 2027, so got a bit of grace there. Before it does happen, then tax codes will be changed, because what you don't want is where you've got the double whammy. You've got P11D that's going through the payroll, and also you've got a tax code, which has got your benefit in kind sort of circulating through the tax code. So they will be updated leading up to April 27. We've still got the electric car tax benefits. So currently at 2% or 3%, increasing by 1% up to 2027, and then 2% thereafter up to 2029. So be 5% in 27 and 9% in 2029. So still quite low compared to gas guzzlers, 37% you see on some of those as taxable benefit rates. Something which HMRC cotton on to is interest rates. So employment-related loans would be where perhaps your director's been has taken a loan out of the business. Previously, the benefit in kind on that was at 2.25% of the loan, where that loan was over £10,000. They've increased it up to 3.75%. So just something to watch out for if you do have directors' loans floating around. And you'll see in the last budget the double cap pickups. So these used to follow the VAT rules where they were over, if it was over 1 tonne, then perhaps businesses would treat them as vans. Van benefits are a lot more beneficial than car benefits. Now it's going to be based on the vehicle's primary suitability when made available. So if it's originally made to carry passengers rather than carry goods, it will be treated as a car rather than a van. Now, we do have transitional rules as normal, so the existing arrangements that you've got in place before 6th of April, they can continue. However, they will need to end either the earlier of the vehicle disposal or the 5th of April 2029. So some time to go yet before they fully disappear, but from now on, they are treated as cars for any new agreements. Making tax digital. So this has been around since 2015, and it just keeps getting delayed. So 2019 was when they brought in the VAT requirements. Businesses that were the VAT threshold required to account for their records digitally, submit VAT returns, etc. So this is now happening. So income tax is coming in from April 2026. So this is going to affect self-employed and property income, property owners. So you can see there, April 26, anyone over 50,000, 27, anyone over 30,000. It will be assessed based on the last filed return, so that'd be 24-25 tax return filed in Jan 26. What we don't have at the moment is anything, it's in the pipeline, coming in for limited company reporting under MTD, partnerships or LLPs, but watch out for those partners perhaps or directors where although they might be getting dividends or partnership income, have they also got self-employed income from another source or rental income, which pulls them into the MTD regime. Yeah, April 27, anyone over 30,000 will be mandated. Something which they are looking at as well is mandatory e-invoicing as well. So this is in consultation at the moment. But they're looking at this, should they make it mandatory for e-invoicing from businesses to business, obviously not business to consumer, that would be too much, and business to government. So not going to happen before 2030 though. So while yet, but it's something which they are looking at. Late payment tax. So again, something which HMRC have cottoned on to is they were charging really low interest rates on unpaid tax. So some owners were spotting that and thinking, well, I'm not going to pay my tax bill, I'm going to put it into a savings account and I can get more tax rather than paying my tax bill. So that has gone up to 8. It was 8.5, it's gone down to 8.25 following the recent base rate change in May. So it's quite high. So
what did they pay in the other way? When they
a lot lower. A lot lower. I don't know the exact rate.
3.7.
Yeah. Probably equivalent to that the employer's loans. So the reason I'm raising this in a couple of areas. One is I mentioned earlier about the quarterly instalments. If you're under quarterly instalments, you could be paying 8.25%. If you've got outstanding corporation tax, 8.25%. It's becoming more expensive, and the real expensive one of our tax managers circulated something the other day was on the VAT penalties. So it's not the VAT, if you've got VAT and you've got a VAT deadline coming up and you're struggling to pay, it's the payment which is the real kicker. It's not the non-filing of the VAT return. With non-filing of the VAT return, you just go into a points system. You build up a certain number of points and after a while you pay a small penalty for non-filing. If you're late for your payment, so day one you're going to get charged 8.25% every day, and then after 15 days further late you're going to get a 3% penalty on top. So they're really trying to knuckle down on late VAT payments. So you could end up with as much as an interest rate of 18% if you pay after 30 days late. So normal days, 7th, isn't it, for VAT payments? So it could be quite high. So one to really watch out for. So it's the payment, not the filing, which is the real kicker. Finally, some deadlines. So like I say, we've still got P11D reporting. So 6th of July is the first deadline for that. So they need to be filed by then. Otherwise you get penalties. And 19th of July is when the payment needs to be made for the class on a national insurance. PSAs. So PSAs where perhaps the company has agreed to settle the tax liability for staff for certain benefits where they're perhaps just irregular, just one-off type benefits. They need to be put in place by the 6th of July following the tax year. So they need to be agreed by HMRC that they can go through PSA. And the final one is employment-related securities reporting by 6th of July again. So 6th of July is a target date for everything. So these are perhaps if you've got share options in place, you need to report on those annually. Or if you've got perhaps shares that have been issued to employees, generally family members fall out of this, but if they're by way of employment, then those need to go be reported to HMRC by 6th of July as well. Any questions? Bamboozled, I think. we will stick around for a while after, so if you want to come and ask us any questions, then please do so. Otherwise, thank you very much for attending. Look forward to seeing you at future events.
Thank you.